Across Africa, governments that have been borrowing from the World Bank and IMF for decades are finally saying they're done playing this game. Kenya's parliament building was on fire, and the people who set it ablaze weren't terrorists or coup plotters. They were ordinary Kenyans, most of them in their early 20s, who were so furious about tax increases that they stormed their own government buildings. At least 39 people were killed by police that day.
Government treat us like foreigners in this place. We are rejecting every single bill. No matter what. In that finance, we are rejecting it, every clause.
A lot of people ask us what's the difference between the IMF and the World Bank.
So let's break down some of the key similarities and differences between the two organizations.
The International Monetary Fund, an institution that promotes global economic stability and perhaps a lender of last resort, or, as some say, an outdated organization whose policies damage the social and cultural fabric of a country.
A quiet financial shift is unfolding across Africa, and it could redefine global power. Governments long dependent on the International Monetary Fund are charting alternative paths, building regional lenders, restructuring debt, and strengthening local capital markets. This isn't a protest, it's a pivot, and if the momentum continues, the era of automatic IMF dependence may be ending. Is Africa stepping into a new financial chapter, and what does that mean for the global order? Let's break it down. For decades, when African economies faced fiscal crises, currency collapses, or balance of payments emergencies, the path forward was often predictable. Negotiations with the International Monetary Fund would begin, program conditions would be discussed, reforms would be outlined, funding would be released in stages. The IMF became not just a lender, but a framework. Its programs often came with structural adjustment policies, fiscal tightening, subsidy reforms, currency liberalization, public sector restructuring. For some countries, these reforms stabilized economies and restored investor confidence. For others, they brought social strain, political backlash, and long debates about sovereignty versus necessity. Over time, IMF engagement in Africa became normalized. It was viewed as the institutional backstop when liquidity ran dry, but normalization can mask evolution. In recent years, a quieter transition has begun to take shape. Across the continent, governments are exploring ways to reduce automatic reliance on IMF facilities. This does not mean severing ties or rejecting global institutions. Rather, it signals a recalibration, seeking alternative buffers before turning to Washington-based solutions. The shift is subtle. It rarely arrives with sweeping declarations. Instead, it appears through policy adjustments, reserve management decisions, regional financing initiatives, and debt restructuring strategies that expand options. Why now? The answer lies partly in experience. Over the past 2 decades, African economies have endured a series of global shocks: commodity price collapses, global financial instability, pandemic disruptions, and tightening international credit cycles. Each episode exposed vulnerabilities tied to external financing dependency. When the global system tightens, access to liquidity becomes expensive. When reserve currencies strengthen, imported inflation rises. When external lenders hesitate, fiscal space narrows quickly. These recurring cycles have reinforced a strategic question among policymakers: how can resilience be built domestically and regionally before crisis hits? One answer has been strengthening regional financial institutions. Continental and sub-regional development banks have expanded capital bases and lending capacity. Institutions such as the African Development Bank have played increasingly visible roles in infrastructure financing, project support, and macroeconomic stabilization. While not a replacement for IMF-scale emergency facilities, these institutions offer complementary tools. They can tailor support more closely to regional priorities. They can mobilize financing with fewer layers of external political negotiation, and they signal growing continental confidence in internal mechanisms. Parallel to this, domestic capital markets have matured in several African economies. Local currency bond markets, though uneven across countries, have deepened in places where regulatory frameworks strengthened and macroeconomic management stabilized. Governments have increasingly issued domestic debt instruments, reducing reliance on foreign currency borrowing. This matters profoundly. Foreign currency debt exposes countries to exchange rate risk. When local currencies depreciate, repayment burdens balloon. Domestic currency borrowing shifts that risk profile inward. While not without its own challenges, it provides greater policy flexibility. Another emerging strategy involves bilateral credit arrangements outside traditional multilateral frameworks. Infrastructure-backed financing agreements, diversified trade partnerships, and multi-currency trade settlements are increasingly part of fiscal planning. The objective is not to reject multilateralism, but to broaden it. Diversification reduces vulnerability. It also increases negotiating leverage. When countries have multiple options, they approach negotiations differently. Terms become more competitive, conditions become more flexible, sovereignty expands at the margins. However, it is essential to remain precise. Africa's engagement with the IMF has not disappeared. Several countries continue to operate under IMF-supported programs. The institution remains an important anchor of global financial stability. It provides technical assistance, policy guidance, and emergency liquidity that few others can match at scale. What is changing is reflex. Where IMF engagement once represented the immediate default in crisis, some governments now exhaust alternative avenues first. Regional borrowing pools, sovereign bond markets, fiscal consolidation strategies, and reserve accumulation policies are explored before formal program discussions begin. This shift reflects maturation. It also reflects a generational evolution in economic leadership. Policymakers across the continent are increasingly trained in global finance, experienced in market negotiations, and confident in navigating complex debt structures. They are less inclined to see external lenders as singular arbiters of policy direction. Confidence reshapes posture. The broader geopolitical environment has also shifted. Global financial power is no longer perceived as concentrated in a single axis. Emerging markets across Asia, Latin America, and the Middle East have expanded influence within global trade and investment systems. African economies operate within this multipolar environment, negotiating partnerships across multiple corridors. In a multipolar world, financial strategy becomes more flexible. Reducing IMF dependence does not necessarily weaken global integration. It may represent a different type of integration, one based on diversified partnerships rather than concentrated reliance. Still, risks accompany autonomy. Alternative financing arrangements can carry opaque terms. Domestic capital markets can overheat. Regional institutions can face capital constraints. Policy discipline remains essential. Without macroeconomic stability, diversification becomes fragility. The balance is delicate. What makes this moment historically significant is not confrontation, but trajectory. If current patterns persist, Africa may gradually reshape its relationship with global financial governance not by exiting institutions, but by engaging them from a position of increased leverage. That changes tone. It also changes perception. For decades, global financial narratives often positioned African economies as recipients of stabilization rather than architects of financial strategy. That narrative is evolving. Countries are increasingly presenting reform agendas on their own timelines, initiating debt transparency measures proactively, and investing in tax administration and fiscal management systems. This signals self-directed reform rather than externally imposed adjustment. Perception influences markets. When investors view economies as strategically autonomous rather than structurally dependent, risk premiums shift, bond spreads narrow, capital allocation stabilizes, confidence compounds, and confidence is as powerful as capital. None of this guarantees a new financial era. The IMF remains central to global stability frameworks. Economic shocks will still require coordinated multilateral responses. Structural constraints persist across many African economies, but something fundamental is shifting beneath the surface. Dependence is no longer treated as inevitable. Instead, it is treated as negotiable, and when dependence becomes negotiable, power begins to rebalance. Because reducing reliance on the International Monetary Fund is not simply a financial adjustment, it changes negotiation dynamics, reshapes investor perception, and gradually recalibrates who holds influence during moments of crisis. For decades, the IMF occupied a central stabilizing role in emerging markets. When foreign reserves declined sharply or external debt repayments mounted, an IMF program signaled discipline and credibility. Markets often responded positively, viewing IMF oversight as a guarantee of reform and repayment structure. Access to IMF financing frequently unlocked additional capital from multilateral partners and private creditors. That signaling power remains significant, but signaling power only dominates when alternatives are limited. As African economies expand regional financing mechanisms, deepen domestic capital markets, and diversify international partnerships, the hierarchy of dependence becomes less rigid. The IMF transforms from first and automatic responder into one option among several. This alters posture. Negotiations change when both parties know that financing is not exclusively dependent on one channel. Conditionality discussions become more balanced. Timelines may become more flexible. Policy sequencing can align more closely with domestic political realities rather than external urgency. It does not eliminate reform requirements. It reframes them. Leverage in international finance often hinges less on confrontation and more on optionality. The ability to consider alternatives shifts bargaining dynamics in subtle but important ways. There is also an internal political dimension. IMF programs historically carried domestic sensitivity across several African nations. Subsidy reductions, currency adjustments, and fiscal tightening frequently produced short-term social strain. Governments balancing reform with stability face difficult trade-offs. When alternative financing buffers exist, whether through regional development banks, sovereign bond markets, or bilateral facilities, governments can pace reforms more gradually. Instead of compressed adjustment cycles dictated by immediate liquidity crises, restructuring can occur over extended horizons. Gradualism can reduce social shock. Reduced social shock can strengthen policy continuity. Policy continuity strengthens investor confidence over time. This creates a reinforcing loop distinct from the historical crisis response framework. At the same time, financial independence requires discipline. Without credible macroeconomic management, diversification becomes fragile. Markets reward autonomy only when accompanied by transparency, inflation control, fiscal responsibility, and regulatory predictability. Autonomy without discipline raises risk premiums. Autonomy with discipline lowers them. The strategic outcome depends on governance quality. There is another layer unfolding beneath the surface: narrative transformation. For decades, global financial discussions often portrayed African economies as structurally dependent on external stabilizers. While that narrative overlooked complexity and diversity across the continent, it influenced perception. Investors, rating agencies, and policymakers operated within that framework. As countries gradually strengthen fiscal frameworks and regional financing tools, the narrative evolves. Instead of being viewed primarily through the lens of vulnerability, economies begin to be assessed through strategic capability. Perception shifts slowly, but when it shifts, capital follows. Sovereign bond spreads narrow when markets perceive improved autonomy and stability. Local capital markets attract institutional investors when currency management demonstrates resilience. Pension funds and asset managers increasingly view diversified African economies as long-term allocation opportunities rather than short-term risk plays. This movement from crisis dependence perception to strategic participation perception can alter capital flows meaningfully over time. There is also the question of systemic ripple effects. If African nations increasingly rely on regional coordination for stabilization financing, regional institutions gain prominence, their capital bases expand, their influence grows, governance capacity strengthens through experience. Over decades, these institutions may accumulate enough scale to serve as first responders in moderate crises. This does not replace global institutions, it complements them. Complementary strength reduces concentration risk within the global system. Financial resilience improves when stabilizing capacity is distributed rather than centralized. Such distribution aligns with broader geopolitical multipolarity. As trade routes diversify and partnerships extend beyond traditional Western axes, financial frameworks tend to diversify as well. The global system becomes layered rather than hierarchical. In this context, Africa's reduced IMF dependence does not signal fragmentation of global order, it suggests adaptation within it. Adaptation carries strategic implications for major powers. The IMF's historical influence extended beyond funding. Policy advice, structural benchmarks, and surveillance reports shaped reform trajectories in borrowing countries. As reliance decreases, domestic policymakers may exercise greater discretion in sequencing reforms according to local priorities. This recalibration does not eliminate global standards, it changes how they are negotiated. From a macro perspective, the IMF continues to serve critical functions in global liquidity management. During systemic crises, coordinated responses remain essential. No regional institution currently matches the IMF's rapid deployment capacity at global scale. Therefore, the transition underway is not institutional displacement. It is institutional diversification. Diversification creates resilience, but it also redistributes symbolic authority. Authority in finance is not only about funds disbursed, it is about whose approval carries weight in markets. If markets increasingly recognize regional institutions, domestic reforms, and diversified funding sources as credible signals, the monopoly of external validation weakens. Validation becomes multi-sourced. Multi-sourced validation aligns with multipolar influence. Another important dimension lies in currency exposure. IMF programs historically addressed balance of payments crises linked to foreign currency debt. As African governments expand local currency borrowing and deepen domestic investor bases, exchange rate vulnerability shifts. Reducing foreign currency mismatches enhances shock absorption. Capacity. It allows monetary policy to operate with greater flexibility. Exchange rate adjustments, when necessary, become less destabilizing to sovereign balance sheets. This strengthens resilience during global tightening cycles. However, progress remains uneven across the continent. Some economies maintain strong fiscal buffers and diversified revenue bases. Others face structural challenges including commodity dependence, fiscal deficits, and governance constraints. The shift toward reduced IMF dependence will not be uniform, but trends often begin unevenly. Before gaining cohesion, the broader global significance lies in precedent. If African economies demonstrate that diversified financial strategies can stabilize growth while maintaining investor confidence, other emerging markets may intensify similar pathways. Such diffusion amplifies impact. A single region experimenting with diversification matters. Multiple regions doing so reshapes norms. Yet it is essential to maintain perspective. The IMF remains deeply integrated into the architecture of global stability. Its surveillance role, technical assistance programs, and liquidity facilities continue to provide essential functions. Reduced dependence does not equate to disengagement. Instead, it signals maturity. Financial systems evolve alongside economic development. As economies expand, institutional relationships evolve accordingly. Perhaps the clearest indicator of change is tone. Negotiations increasingly occur as partnership discussions rather than emergency rescues. Fiscal reforms are framed as national strategies rather than externally mandated adjustments. Regional cooperation becomes proactive rather than reactive. Tone reflects power, and power, in global finance, rarely shifts dramatically. It adjusts through positioning, credibility, and accumulated choice. If Africa sustains macroeconomic discipline while strengthening internal financial capacity, its role within global governance structures will naturally expand. Influence will derive not from confrontation, but from competence. The world may not witness a sudden headline declaring a new financial era. Instead, analysts may look back years from now and recognize this period as the beginning of a subtle redistribution of economic gravity. Reduced dependence does not dismantle the system. It recalibrates it, and recalibration, sustained over time, becomes transformation.